Assalamualaikum warahmatullahi wabarakatuh. My name is Siti Nur Balkis binti Jazmi. My metric number 0DA22F1075. I'm from DA1A. My lecturer's name Puan Nurul Huda binti Yahya. Today, I would like to present about realization, which is from topic 8, accounting process and book of account. The realization principle of accounting helps accountants understand when they can recognize and record a payment received by their client as revenue. According to this principle, accountants can record revenue when their clients complete a service or a delivery product to a customer. Once they complete the service or delivery the product, the earning process is complete, and you can record the transaction. This principle involves realizing revenue or recognizing it as deserved, and recording it only when the client officially completes the earning process rather than when they actually receive the payment. Example for revenue realization concept. 1. For goods sold and advance payment. If the buyer has made the payment for corresponding goods before the delivery is made, then according to the realization concept, the revenue is not going to recognize until and unless the goods are transferred to the buyer. Even though the cash has been received, this is known as the transfer to the risk and reward because the risk of damage or loss of goods eliminate the delivery has been accomplished. For example, payment of a Toyota car is made in full on 5th March 2022, but the car is delivered on 15 March 2022. The revenue will be recorded on the 15 March 2022.
For the second example, for goods sold on credit. The second scenario is when the payment for corresponding good is made after the good have been delivered. Again, the accountant is not going to wait for receiving cash to recognize revenue. Instead, according to the recognition principle, and receivable account will be created and the revenue is going to be realized the moment it is earned at the time delivery of goods has been made. For instance, the business has delivered goods to the customer on March 20. However, payment is to be received in February. So the revenue needs to be recorded on 20 March because risk and reward has been transferred on this date. The third example is for services rendered. If services are to be rendered at a point in time, the revenue is recognized as soon as the service has been performed. But if the services are to be provided continuously for more than one accounting period under consideration, then the percentage completion method is followed. According to this method, the revenue is recorded based on the percentage of total service rendered. For example, a catering business agrees to provide catering services to a movie production house for 2 years for 6,000 ringgit. From the catering perspective, if this payment is received in advance, then it will be recorded as deferred income during 2 years. On the other hand, if the payment is made after the completion of the project, then it is considered receivable throughout the duration. In either case, only the percentage of services that have been completely delivered is realized as revenue every month or year. For instance, in this example, 250 ringgit, which is 6,000 ringgit over 24 months, will be recorded for the service rendered each month. The realization concept is legally compliant with the law of transfer of property. Also, it reduces the risk of doubling revenues. It's a fair method as it's not confused on the collection of money only. Rather, it's confused on transferring goods or services and then the collecting rightful amount to it. As you guys can see, this is the benefits and drawbacks of using the realization principle. The first benefit is reviewing finance without waiting for payment. Second, creating budgets and understanding available cash. Third, more payment options for customers. Fourth, examining individual sales and patterns. For the first drawback is overstating available cash, affected by delay and cancellation, recording revenue too early, potential double entries. The conclusion of the topic is the revenue realization concept is of the view that revenue should be recorded when related risk and reward of the transaction are delivered to the customer. This concept is important for completing cut-off accounting assumption. For these services, revenue is recognized when the services are rendered. If service is rendered in one more than accounting period, the percentage of completion is used in revenue recognition. That's all for me. Thank you.